Really excited to kick things off here. By way of introduction, my name's Adam Herwagen, and I work for Slow Ventures. And this is our now fourth convening of our life capital discussion focused on the income share agreement space and educational finance more broadly. Before I get into some of the logistics of what to expect for today, want to give a sincere thank you to both of our co-hosts, Jobs for the Future and Whiteboard Advisors, for both helping us shape the panels and the topics for discussion today, and also helping us recruit such an amazing cast of speakers. Quickly to set the stage for what to expect for today, we will be having 4 really quick hitting 25-minute panels, and thematically they're structured so that we're starting with really broad strokes on what are some of these different ISA programs and how do they differ, and slowly getting a little bit more detailed and in the weeds about some of the legalities and policy implications for the ISA space moving forward. Next, want to just point out that we do encourage you to ask questions throughout the entire conversation using the Q&A function on the bottom of your Zoom panel. Given that they're 25-minute panels, we won't be able to get to all of them, but I'll be adding all of you that aren't already a part of our Life Capital Google group and community to that Google group afterwards, so that I can post all of the questions and we can continue the conversation afterward there. And finally, just want to note that all of today's conversation will be recorded. So if you can't make one of the sessions or can't make the entire thing, do not worry, we'll be circulating the entire recording afterward. And with that, I will pass things off here to Sam, who will be kicking us off with the first panel. Sam, do you want to come on up?
Adam, thanks for the introduction. I'm Sam Wesson. I'm one of the general partners at Slow Ventures. We are very excited about the ISA space and have been for a long time for a whole bunch of reasons. Actually, the first company I ever personally tried to start, as some of you who have attended before, was in this space a long time ago in 2001 called Life Capital. We literally reused the domain that I've held since 2000 for exactly this purpose. So we're thrilled to be doing this yet again with kind of the people that are most passionate and engaged in the space around ISAs and more broadly, just this future of how do we think about a world beyond traditional personal debt? Debt is an incredible instrument. I'm not anti-debt as a concept, but it also has its limitations and failings, as we all know, from a social perspective and from kind of opening up opportunities for people. It's a great opener of opportunities, but it also has some serious flaws. So, I'm going to have the privilege of hosting the first 2 panels, and then we'll go from there. The first panel that I'd like to invite everyone to come up for is starting with the provider model brainstorm. So Tess, Jason, and Steve, I think you guys should all turn on your calendars. I think we have almost everyone's calendar is on. It's great to see you guys. We have 3 great leaders and builders here with taking different approaches. And so I'd love to start the conversation just by talking a little bit about the breadth of different provider models. Like ISAs is not one thing. It's a whole set of different approaches in the space. So maybe guys, if you don't mind, start off by just, briefly introducing yourselves, what your efforts are around the space, and then nothing, just a few thoughts on kind of some of the breadth, some of the different options you see out there in terms of how people are approaching ISAs more broadly. Tess, you're unmuted. Why don't you start?
Yeah, absolutely. Thank you so much for having me, and really excited to be on this panel with Steve and Jason. My background has really been split between mission-driven startups and finance. I actually founded Stride from a student-first perspective. I was a graduate student at Harvard thinking about my own financing options and realizing, I'm sure as many students do, that once you add books and tuition and housing, it gets pretty expensive pretty quickly. And I'd always been intellectually fascinated by ISAs, but realized most of the solutions in the market were point solutions, right? You had servicers, you had financers, but there weren't truly end-to-end solutions, and especially not ones that really changed the narrative from being a financial provider to a partner with these students. And so we really built this end-to-end solution that has career support to really help students on the back end as well. And it's been such a fun journey building it so far, and definitely interesting to see kind of the increase in demand, especially in a COVID environment when students really are much more cautious about how to pay for school and much more thoughtful about different funding solutions. So thank you, and great to have these panelists joining me. So.
Awesome. Jason, you want to go next?
Sure. So my name is Jason. I'm the founder and CEO of Free World. Free World is a tech-enabled nonprofit that aims to end the era of mass recidivism by placing people with criminal histories into high ROI careers and unblocking roadblocks to their success so they can live fulfilling lives prison-free. The reason why I started this work is because at the age of 15, I made some really terrible decisions, and I ended up going to prison on a 12-year sentence. And after getting released from prison, I realized that everywhere that I went, either for a job, for housing, education, even the right to vote, people saw me as the worst thing I'd ever done rather than the person I was today. And because of that, I was barred from almost every opportunity out there. So that really got me thinking about different ways that we can help other people that are in similar situations. And we really took hold of the ISA model because one of the main challenges for people with criminal histories is finding that opportunity for employment and getting the education that they need to have the skills to be successful in that career. And ISAs provide a really interesting model for us to invest upfront and allow our graduates to then pay it forward to help the next couple of students go through our program.
Awesome. And Steve, our third panelist, your quick intro.
Yeah, my name is Steve. I lead the enrollment division at Jessup University. Apologies for the white on white. I've always been told not to do that on Zoom. Today I'm at a remote office at our extension site. Then I was going to have a white background. So apologies to the whole entire panel and to our honored guests. We're pretty much a straightforward approach in terms of ISAs. It's what we call a benevolent ISAs, and simply kind of bridging the gap between what the students can afford and what the gap is. And we believe ISA is just a really creative solution to that. So we do what we call an evergreen or a benevolent ISA, where it's essentially it's a 0% loan, and it's your ability to pay obviously afterwards, and your ability to find a job afterwards. And there's a set time, and once that expires, it's done. So we really thought it was a great way to challenge us, actually, because higher ed for a long time we've been touting, hey, if you have a bachelor's degree, you're going to be job market ready, you'll have entrance into the middle class. Well, we're going to put our money where our mouth is. So we want to use the ISA to kind of prove the worth of our product, which is higher education. So I think mine is probably the most boring out of all the panelists, but it's kind of a bread and butter system here at Jessup.
I don't think anything's yet bread and butter or boring about the ISA space. It's like, but point taken that there's kind of, in terms of what's going on. So look, I mean, ISAs is an old idea, from an academic paper perspective. I would say that the boot camp movement, 5 to 10 years ago really pushed it from kind of a fringe concept into the mainstream for a bunch of reasons. We're now seeing this explosion, right? Colleges, programs like Jason's helping people kind of get access to capital, that are ex-cons and like find really high paying jobs they don't have access to, Tessa's model. There's just a huge breadth going on. I'm kind of curious, like when you think about kind of how do you even classify the ISAs as like the class of things that are not traditional debt where you pay back on a certain, a time horizon, a certain amount? Like, what are kind of like some of the edges you're seeing of that, of the, kind of the places people are exploring the space? Like what, Steve, if you are jokingly saying that what you're doing is kind of the most up the middle, what are kind of some of the extremes you're seeing?
Well, I think one of the extreme things that I'm seeing is, I would say the number one public university that really took to the ISAs is Purdue. They really, they call it Back of Boiler program, which is named after their, mascot, but they're really doing it on a massive scale. And they're really at the fringes in terms of, it's not just for undergraduate education anymore, it's for graduate programs, it's for medical school. And they're really pushing the boundaries of this idea, hey, if higher education is all that we think that we are, let's put our money where our mouth is, fund this thing up front with our own funded scholarships. And then let's see if the students go get a job and they really do get that access to that high paying job. Because if they do, then they can pay back. If they don't, it's going to expire. So for me, I told you earlier, that sounds like a bread and butter concept, but you're right in the sense of the university taking the risk of funding that up front. I think that's pretty risky and pretty cutting edge.
Yeah, I would add to that and say, I think the broader movement is not necessarily just a, income share agreement movement, but the whole premise being around outcomes-driven financing. And we see lots of innovation in the space around ISAs, income contingent deferred tuition contracts, income contingent loans. And I think we'll continue to see that push, and each institution has its own flavor of what they think is more student friendly or makes more sense. But I think the use cases for this are fairly broad. We saw it start in the boot camp space, expand to become more mainstream in Title IV. We've seen applications of it for Dreamers and DACA students who don't get access to federal student loans, which is really powerful from an impact perspective. And I think that, Steve really mentioned that there are different ways to finance this. There are traditional investors that look at this like a traditional equity investment in a way. And then there are folks that create evergreen or revolving funds. And I think that is really interesting as we think about who are the supporters of ISAs and who are the beneficiaries of it.
So, Jason, anything to add to that? Other things you're seeing on the edges?
Yeah, so I think the ISAs are a really interesting funding model to be able to help our most vulnerable populations. As an example, there's 77 million Americans that have a criminal record, and many of them are barred from so many opportunities in order to really just move forward in life and lead productive lives. So for Free World, this has been an interesting model, not only to help fund the education and job placement of people that are really just looking for a career and to be able to take care of their families, but to see that pay it forward aspect. People are really excited to be able to help the next person. Yeah.
So I'm curious, you guys, like, there's obviously a lot happening in the world, if you didn't notice. And I think, in my mind, the three things that come to mind that are kind of impacting this model the most, and I'm curious if you have others, would be one, an extremely low interest rate environment, right? Even lower than we were before, right? To the point that, unless you are in a vulnerable population or a specifically limited population, i.e. ex-convicts or dreamers or things like that, like, money is basically free right now, right? On top of the fact that you have COVID, on top of the fact that you have changes going on in Title IV, et cetera. So I'm kind of curious, like, when you guys think about the provider business model and the model of, okay, who's providing the capital, who's sourcing the ISAs, who's paying them back, things like that. How do you think, what changes or reverberations are you seeing of what's going on in the world right now in terms of how people are thinking about organizing these models and how the models are working?
Well, for us, I think the innovation is going to come in our, hopefully, a reduced dependence on federal and state funds. Don't get me wrong, I love federal and state funds, and I think especially for a vulnerable population, Jason talked about that. For us, the underprivileged and the underserved communities really need the ISA as a bridge gap to access higher education. But for us, I think ISA will open up the world into not always having to depend on the federal and state government to fund the dream of the underserved and the underprivileged student. So for us, I think it's step one of many steps that we're going to take for us to become really completely independent of federal and state money and drive more private equity into the ISA model and into a more institutional model of financial aid that's much more friendly in terms of paperwork, bureaucracy that you have to go through, much more efficiencies that you can achieve in accessing aid and accessing funding. So for us, we see that as a brave new world in the future.
Yeah, I would add to that and say, I think we can all agree that the education space has definitely evolved over the past 6 months. But as we think through federal rates, you're right, they're down 200 basis points. And for many students, we always advise that they take direct, subsidized federal loans first before ever thinking about a private loan or an ISA. But the real question for students is really, it's not, a loan or, debt and ISA, it's really more debt versus an ISA. Many of these students already have outstanding debt from their previous educational experiences and are really thinking through how to just support themselves and have a bit more, room to breathe when they think about, the job market that they're going to come into. The other piece is that I think there are so many broad applications for ISAs where federal funding isn't an option. And that's why we've seen such a high percentage of boot camps offering ISAs, because they don't have access. Also, second bachelor students, for example, in nursing, don't have access to more federal funding. And then, of course, there are caps in undergrad as far as the amount of federal funding you can take out. And so really where ISAs come in is as a much more flexible and affordable alternative to private loans. And that's really where we position ourselves.
Yeah, I think that for ISAs, a lot of people that we serve are coming out of prison. They have no credit history whatsoever. There's a 10-year employment gap, and they can't get access to a Pell Grant. So the way that we've been able to leverage ISAs is that there seems to be a huge appetite in philanthropy to be able to fund models like ours. And this will allow us to essentially become self-sustainable and grow organically and just leverage philanthropic capital at scale.
Makes sense. So, I mean, you guys, obviously so much of the space is tied up because of the scale in the federal loan programs and things like that. I mean, one of the attendees, and I'll get to some of the questions that come up, but I think it's relevant here. You know, when we think about kind of the different ISA models, where they've evolved, and then kind of like how the providers models might change, like what does this look like under a Biden administration? Like what are things, I probably shouldn't bring politics into it. I was gonna say hopefully. So assuming a Biden administration or kind of different people going in different directions politically, or we can just call it more conservative versus more liberal policies and kind of the extremes we're seeing things pushed to with the COVID era. You know, for instance, Jason, like, you know, right now your model, obviously, you know, ex-convicts do not have access to a lot of these loan programs. They don't have a lot of support, et cetera. In a world where the federal government comes in and does offer, says, look, we need to solve this. Like, we're going to offer like really low, you know, inexpensive loans, you know, to help people get back on their feet. Is your model relevant anymore? Is the ISA model relevant anymore? Or do you think that kind of just, you know, good old traditional, you know, debt works just fine?
Yeah, so I think that there's always going to be a space for ISAs. When people hear about the opportunity to essentially get the investment upfront, to get the education they need to get into a high-paying job, and the only way that they pay back is if they're earning above a certain minimum income, why would you go debt? Because through the ISA model, the incentives are aligned with the school and the student. So we don't get paid unless we really do a good job of getting our students paid well.
Yeah. Fair. And I guess that's to test to your point a little bit about outcome-oriented education and opportunities, where people are being forced in the modern economy to take more risks in terms of the things they invest in with their time and effort and money, right? And like when you're forced to take more risks, you know, people are looking to effectively hedge those risks a little bit, right? So that they're not ending up exposed when they don't actually know whether your new program or whatever is necessarily going to provide the outcomes, and looking for that alignment. Is that a fair way to categorize what you were saying?
That's spot on. I think that's exactly what we think about for this movement around outcomes-driven financing. And, you know, I agree with Jason. I think there's a lot of ways that this shows alignment of that cost and value of education, especially when you think about industries that are newer or still up and coming, especially in the boot camp industry, that is a big focus. With that being said, I think, you know, as we think about a potential Biden administration and the push toward more regulation around the ISA space, what's really special about the ISA space is I think so much of the players in the space are focused on self-regulating and really utilizing best practices for how do we align how, you know, the compliance and disclosures that are used in an ISA space are as closely resembling what you would see in a private lending world, so that we can be proactive, not reactive, if change were put in place. And especially when you think about good actors in the space, the terms themselves, as far as caps or minimum income thresholds, are so far within the bounds of what we've seen recent bills being proposed within. And so in a lot of ways, it just, again, reminds us to all stay alert and stay student friendly as far as how we structure our contracts and our provider system.
Yeah, fair enough.
Yeah, and I don't know if you knew this, but you know, Elizabeth Warren actually has, I think, kind of led the way in terms of increasing regulation in the ISA space. Many of our sister institutions have actually, who went and did the ISA program already, have received letters from Elizabeth Warren regarding an audit of their practices. So I think in that sense, I think the Democratic Party, if they were to come into power, again, not getting too political, they're going to increase the scrutiny behind ISA. I already sense it. So I think luckily for us, and it's good and bad in the sense that higher education is already so regulated with so many, I guess, limitations and boundaries. So in that sense, we kind of already passed the mustard on the scrutiny behind, let's say, the Democratic Party if they were to come into power. But I cannot emphasize enough that I totally and absolutely agree with Jason that anytime you do an ISA, it has to be student focused. It has to be centered around student success. And as long as we do that, we'll pass any regulations that come our way.
Got it. So what evolutions do you guys see then? You know, we'll talk more about this in future panels, but I'm kind of curious because I think you guys represent very different models. You know, in terms of the actual structure of ISAs, you know, what do we have the model? Do we know what we're doing, or do you think there's going to be a new generation or new opportunities coming up, that structure ISAs or the approach to the market differently? And I'll just to kind of, feed out a little bit of this. When I first was excited about ISAs a long time ago and trying to get projects started around them, I was, I think, wrongly at the time very focused on a marketplace model, right? Of matching effectively, mentors or basically investors, right, with students, right? There are people, I think, even on this call who are kind of thinking about and starting to work on models like that in certain verticals. But I'm curious to you, in your minds, if you think that what we currently see as ISAs, they're focused industry-wise, their actual structure in terms of how they're deployed is where we're going to be in 10 years, or whether you think there are changes coming in terms of those types of things in funding source or structure that you think will meaningfully change how we think about what a quote-unquote ISA is.
Yeah, so my personal opinion here is I think so the space itself is still so nascent, right? Steve, you mentioned Purdue, that was the first big university to adopt ISAs, and that was only a few years ago, right? And so in a lot of ways, data is going to be the biggest determinant of how we structure ISAs and how we think about driving fair rates to students and also fair rates to and fair returns to investors. And I think we realized that very early on in our life cycle with Stride, and Sam, you know this, but we had done an asset acquisition of a data science company that spent 4 years building proprietary ISA models. And a big reason for that was we realized we wanted to accelerate our time to market and make sure that we were selecting student segments that we were able to give the best rates to. We needed to really understand how do we predict income, most accurately. And I think going forward, as we collect more outcomes data, that job and that task becomes that much more, that much more improved and that much more stronger. And so that is a huge, thing that just takes time. I mean, I think as we think about the next 5 to 10 years, we'll see the model evolve. Right now, we all have our own view on what caps should look like, what a minimum income threshold should look like, and what, fair ranges for the percentage of income should look like. So it'll definitely evolve, I think.
Yeah, so at Free World, what I'm really excited about with the ISA space is that the way that the structure is set up, it forces organization to create a really amazing program and really amazing outcomes. And so the way that we look at this is that getting a high-paying job is only one side of the equation. The other side of the equation, especially for vulnerable populations like people with criminal histories, is that you have to take a look at the entire picture and really unblock a lot of the roadblocks that stop people from being successful. Because if somebody ends up going to jail or going back to prison, then guess what? Our ISA is dead on that particular person. So what we've done is we've developed a full stack solution that really attacks 5 core areas: housing, transportation, education, job placement, and wealth management. With wealth management being like one of the key reasons why we're able to be successful. Our mindset behind here is that we can place somebody into a good paying job, but also help them manage their money. So that way they can start investing in their families and futures and end the cycle of generational recidivism and poverty within these families.
Well, I mean, again, I think my mind's a little bit more boring in that sense. What we're trying to do is we're trying to help this current generation. And I have several articles that show that this generation at times, and COVID has actually even augmented this even further, the idea of persistence and having grit to finish things might not be as readily apparent. So for us, ISA, it's actually, we consider it kind of like a retention tool and a completion kind of a measurement. And what we're doing is basically using the ISA to also not only fill in the gap of the financial lack, but also ISAs encourage students to finish their degrees as well in completion. Because, and I'm going to get persecuted by my fellow higher ed people on this, in addition to the content that we teach, I think higher education, another great value is that we teach people to finish. That finishing things is very important. And ISA becomes another facet of that tool that encourages the student to finish what you started, because that's another valuable life tool that you'll have upon graduation. So for me, again, it's not as sexy, but ISAs, we use it as like a completion tool, a measurement that's going to be a predictor and an indicator that you learn how to finish things in the future. So we're really excited about that. Boring, but yet kind of an exciting concept.
Yeah, and I guess that like the question of like incentives and how these things end up, playing out are very interesting. So for instance, Steve, I'm curious, this is always a question in this kind of space of selection bias, right? So like, are you selecting students are your programs or the programs that are around the ISAs teaching people to finish, or just selecting for people who are committed to finishing, right? Or, are you, how do you think about kind of how these models, where all of a sudden on one hand, there's a wonderful component of saying, okay, well, if my incentives are tied to your incentives as a school or a program, then like that's a really good signal for the student that the school is serious because they're putting their money where their mouth is. But on the flip side, like there's some issues around, or questions around, all of a sudden, the schools have, a very big incentive to maximize, in theory, earnings, right? Depending on how these things are structured, which might bias away from certain types of important industries or more whole lives or whatever, things like that. So I'm kind of curious, like, when I think about how people digest those incentives, right, and how they change based on sources of capital and things like that, it's a very different world if hedge funds are supporting ISAs versus, or in the background, right, versus the federal government. If you kind of see, more, I'm sure there'll be more evolution, but more challenges around that space, and kind of innovation around different structures of setting these things up.
I would go back to Tess and Jason's answer earlier. I think as long as you structure the ISA around student success, I think that becomes a natural accountability on not manipulating that system for revenue. So for us, the ISA is built on top of our unfunded scholarship being discounting mechanism. So in addition to the scholarship that we were already going to give you, we're giving you the ISA on top of that. So for us, that's a natural accountability where we're student focused. We're saying we don't want you to be in debt. So we're going to use this ISA even on top of what we were going to give you, so that the tuition gap is bridged for them to do that program. So for us, that's an internal natural mechanism. And two, again, for us, for better or for worse, we're a highly regulated field by the federal government and the state government. So if we were to do any kind of manipulative practices, we're basically digging our own graves at that point. So
yeah, no, and again, I'm not looking at you or anyone as being manipulative intentionally. It's more about kind of unintended consequences and how these things play out over time.
Yeah, well, then thanks for clarifying that. But yeah, I like to think that present day moment we definitely have internal accountability mechanisms set up. But if you're asking me in the future, will higher ed take advantage of this and let it become something that's controversial? I can't answer to any other institution, but our intentions are very clear that it's going to be a student success model.
Fair enough.
Yeah.
Cool. Well, we're almost out of time. Anyone else have thoughts or want to share anything? There's some questions I think we should try to get to probably after the panel over email. We can kind of route them around to the right people and things like that. But about a little bit more about kind of where we are and kind of the structure of ISAs and kind of the pipeline of how they're set up, broadly, and then kind of where we're going. You guys want to share any more thoughts before we move to the next lightning panel?
Yeah, so I can go. So really, the ISA model right now is more urgent than ever, especially for the people that I serve. So inside of jails and prisons, people are dying because of coronavirus. And so states are responding by releasing thousands of inmates into an economy that no longer exists. So it was hard to get a job before with a criminal record. Now it's almost impossible. At the same time, you also have other nonprofits in the space that typically are the front line to be able to provide services for people with criminal histories, and nonprofits across the United States are hobbled right now because many have a really local high touch model. So I think that the way that we've set up our ISAs, as well as the field that we've selected, which is trucking, there is such a high demand for the last mile truckers, and we can take in a applicant and within 45 to 60 days, get them into a good paying job, and then really ensure that they're successful over the long term. So just one key highlight to throw out there is that, we're all suffering from coronavirus. People with criminal histories, they are the most disadvantaged at this point. They literally have nowhere else to go. And I think that we have a model that works.
Yeah, I would add and say, I think it's really meaningful in a market environment like today for each of us on the panel and many of the attendees here to be part of the solution and part of supporting students. I do think it's really also interesting to just see the broader tailwinds coming out of the evolving education market beyond just ISAs. It's fascinating to see the growth in alternative education in these moments when students think about the ROI of their programs. Or the shift toward online degree programs becoming something that students become more comfortable with. And it will be fascinating, I think, for each of us to really keep a pulse on the space as we think about the financial solution and how that ties into the broader educational solution, right? Because we are solving a broader issue, which is tuition has continued to increase, and this is a way to add some relief to that. But there are definitely ways, higher up to really think about becoming a broader part of that solution, which I think many of us who are at this conference today can really think through, collaborate on, and work together to really make a dent there. So.
Fair enough. Guys, this is great. Thank you for joining and for helping kick this off with this first lightning panel. I think we'll go to the next panel for now, and then hopefully again, we'll be routing questions around and things like that. There's one that keeps coming up. Maybe we can address throughout the day, and I think maybe you guys could think about too, which is minimum thresholds and how do we think about effectively what income protection really means and things like that. Maybe we can get that in the next session, but then also just more broadly, I think to pin. But lots of activity, lots of engagement. So thank you for joining and helping kicking this off. And we'll talk more later. With that, let's switch to our second lightning panel with Chris, David, and Rob. We're going to talk about kind of ISAs and what else. We've started hitting on this a little bit. If those guys want to turn their video on and come up. We started talking about this a little bit, kind of thinking about the provider brainstorm and different provider opportunities and how these things are set up. But obviously, there's a lot of innovation going on, right? In kind of the broadly the space of alternative finance and alternative approaches to kind of personal finance in particular, from social impact bonds, all sorts of vehicles around merit-based financing, et cetera, et cetera. These are not new things; they're just things that continue to kind of become more relevant as the world gets more complicated. So again, maybe Rob, do you want to go first, and then David and Chris, just do a quick intro on kind of what you guys are up to and how where you think about kind of how ISAs fit into this kind of broader ecosystem.
Hey, thanks, Sam. Good morning, everybody. Rob Hunter, founder and CEO of Lexria. Lexria helps consumers actually with the process of including existing student loans in bankruptcy. Bankruptcy is a big, scary word, but it's actually a process that I went through personally about 10 years ago. Without it, I would not have been able to go on and kind of get into the tech ecosystem, start a successful SaaS company. But there are actually about 250,000 student debtors, folks with student loans, that are declaring bankruptcy every year, and yet only a few hundred of them are attempting to challenge the inclusion of their student loans in the bankruptcy. There's always been this pervasive belief that it can't be done. Turns out it can under very specific circumstances, particularly when there is a high level of debt and a modicum, sort of medium level of income. It actually becomes possible to discharge your student loans with a bankruptcy filing. And so we help consumers connect with an attorney that can do that for them. We've got a really aligned incentive program in terms of how things are paid for. And it really is just this fascinating sort of tangential thing to the ISA, sort of ecosystem. I had asked, by email with the panel earlier, it's like, our role in this is to almost, pardon the expression, drain the swamp, right? We've got nearly $2 trillion of student loans right now, significant portion in default. Can someone with existing student loan debt take advantage of all the good ISA work that's being done by everybody on the panel today? That's something I'm really interested to explore with everybody.
Cool. David, you want to jump in next? Oh, we can't hear you.
Can you hear me now?
Yes, we can. You're back in business.
Sorry about that.
No worries.
Sorry about that. The Zoom economy. So it's a pleasure to be with everyone this afternoon. My name is David Halween, founder and CEO of Equity. So our work at Equity is focused on streamlining access to the safety net for students, which includes emergency cash assistance. So we offer a student-facing white label product that allows us to do application intake for emergency aid, process those applications, and get cash grants to students in less than 24 hours. So really trying to help students who are dealing with non-tuition related expenses get over those financial humps and be able to persist. For us, we view a lot of these sort of failures around student financial success as policy failures, which I'm sure many on this call view. And one of the things we're really excited about is, we work with students who would be viewed in sort of credit terms as subprime, right? As folks that don't really either have low or no credit. And we want to be able to show through rigorous research how students really are just in need of cash to move the needle on their post-secondary outcomes, and how we can start to build more equitable, sustainable, both public policy funding structures as well as credit risk models to support these students. So that's sort of how we think about ISAs, is sort of, as we have more data about the students we're serving, how we can build more sustainable models for equitable outcomes. And in the short term, we're doing that through cash grants.
Fair enough. Chris, how's it going?
Great. How are you?
Doing well.
Thanks for having me. My name is Chris Keaveney. I'm the co-founder and CEO of a company called Meritize. We started about 4 years ago. And what we focus on is merit-based financing for skills-based careers, right? So we operate almost entirely outside of the traditional post-secondary system. I think I'm probably the token old grumpy credit guy on the panel. So I've been in consumer credit for over 25 years. Spent 4 years, 4.5 years during the financial crisis as JP Morgan Chase's credit officer for their student lending business. I was credit officer for SoFi very early on, 2014, 13, 14. And really, I think from where I sit, one of the big issues with this post-secondary education space is not only how you finance it, but how you provide access to people. I think, Jason, who was on the first panel, it's inspiring what he's working on. I think, there's segments that you can find all over the place where people are not able to get access to training, schooling, whatever it is that's going to allow them to take that next step in their lives, really, in their families' lives. So one way that we attack that is through providing financing based not on someone's credit, not based on it's a little different than an ISA model because it's not based on what we expect their job to look like or their income to look like on the back end of this. It's based on what they've done that indicates that they have the determination and grit to be successful at the training they're trying to get. And what we found is that approach actually leads to positive results. So I'm excited to be here. Happy to jump in and provide my thoughts.
Yeah, I appreciate that, all of you. Thank you for joining. So I think the question in my mind is that you guys all have different really interesting spins, right? Which you wouldn't traditionally put in like an ISA bucket. And I guess the question in my mind, maybe to be funny, phrase it a little bit in a funny way at an ISA conference is our long-term, is ISA even a space, right? Or is it more this kind of idea that outcome-based financing coupled with like better non-traditional non-credit score style inputs, right, is just going to blow open how we think about allocating and pooling capital, right? Especially when it comes to, kind of individuals, of which all of what you're doing are components. And this idea that maybe there's a floor when you pay back and variable payback is like a small component of this kind of broader overall movement, if that makes sense. Like, does that make sense? You think about the Venn diagram. Is ISAs actually a bubble, or is it just a feature of a broader, much shift that you guys are talking about?
I think it's a feature. I think one question that the next 20 years will answer is what portion of the overall student population, if we can call it that, how close to the edge cases do we cover with ISAs? In other words, like, are we able to help out folks that get into trouble? Are we able to address challenges for folks that have something bad happen and are not able to ultimately earn? Like, does it work for the middle 80% of the population? Great, but how far to the edges will it eventually have utility is something I'm curious about.
I would jump in and say that, Sam, to your question, my perspective is that over the course of time, it's a lot of these different and innovative approaches are going to meld together, right? And we're going to end up with an approach that takes the best parts of all of them, right? I think there are a lot of good dimensions to the ISA concept. I do think that as a lot of people have said, it's nascent, and we're going to see how it plays out. I think there's some good dimensions to some of the other financing models that we see out there that can be blended with those components to an ISA, and we get to a product where ultimately I think what you're doing is you're giving someone access to education where you believe and you can quantitatively show that it's going to be a positive ROI investment for them, right? And if that's the case, then I think you're going to have success rates that are great, acceptable, whatever term you want to put there.
Yeah, not to be boring, but I would certainly agree with Chris's take. I mean, I think that at the end of the day, the ISA is an instrument, right? It's an innovative financing instrument to try to align student outcomes and risk profile with their ability to access education. And I think that we're all, continuing to take new innovative approaches and try to tailor the instrument in different ways to different populations of students. So I think over time, the regulatory sort of environment will also help us directionally answer that question. But I do think that, it is helping us talk more about innovative financing structures for students, and as sort of one structure that is informative, but certainly not itself a field.
Yeah. And I guess the question is, when you break down the components of like what people care about in ISAs and their benefits, there's obviously expanding access to capital, period, right? It's just saying, look, you maybe you didn't have access to capital and now you can under this alternative model. There's the alignment thing, which comes up a lot, right? Saying I want to access or I want to try more esoteric or less, places where actually the issue isn't whether the student is clearly high ROI, it's whether the institution is, right? And saying, look, I'll do this, but only if you take some risk with me. Then there's obviously, this question beyond that of just, so it really matters like who's taking them, who's financing them, and the kind of componentry can be mixed. Is there a world in which with better risk modeling and like better understanding of a lot of these inputs people are trying to figure out, David, whether it's what you're trying to do and measure kind of like and get data around, or kind of more of these alignment questions, or Chris, I'm sure you have this as well in terms of your model, understanding like, okay, when you do this, how do you prove, or like to what degree of certainty can you actually model the impact of your model, and therefore what's your borrowing rate to some degree, or like how is there a world in which we get to a place where we have such good modeling on outcomes that I really can kind of choose my own adventure as an individual? There's going to be, some form with a bunch of drop downs and it says, which features do I want on a very customized loan? Or do you think that there'll be kind of always be like more packaged products, that kind of fit into kind of cohorts where you really can't mix all the variables, right, that we're talking about across the ISA space and other forms of alternative finance, but it's much more structured in terms of what's being offered?
So I'll jump in. There's a lot to unpack there. That's a great question. I do think that, at a very high level, we'll continue to get better at the modeling piece of this, right? Which obviously drives the ability to tailor products to individuals, right? So, I think that part is relatively easy to answer. It does get very nuanced though, right? So I will tell you, like from where we sit, our mission is around providing awareness, access, and advancement within the skills-based community, and we're relatively agnostic to how we do that. Like we're not tied to a particular product, so we're always trying to innovate the products. We don't offer ISAs, and one of the reasons we don't is that they are very sensitive to predicting someone's income. And that is a hard problem to model, right? And so in a normal loan, it's kind of a binary outcome. Is this person going to earn enough to responsibly be able to repay whatever debt they take on? That's a hard enough problem. ISAs turn it into a continuous function where not only are you trying to predict whether they're going to have enough to responsibly repay, you're trying to predict exactly how much income they're going to earn over the course of time, because that has a big bearing on the efficacy of the product, and that's a tough thing, right? And in some I think in some industries it's feasible to do, and others it's not. And I think the widespread applicability of ISAs is going to come down to whether that can be done.
Yeah, no, to piggyback off of what Chris is saying, I mean, that's why I think many of us are so excited about ISAs and like a boot camp or a Smile program where there's that pipeline with an employer where that income is more predictable. When you start to generalize, you know, I'll take the current political, or I should say cultural moment of the country, right? I would start to get to worry about racial equity and what happens when you over-engineer the model, right? You start to do false attribution between you know, the ability of someone to earn or sort of median earnings relative to soft social factors, right? Is it a product of the institution and the outcomes they're providing, or lack of access to a social capital network or internships or softer factors like that? So those are certainly considerations that, and to Chris's point, it's highly nuanced, and it is of course a responsibility when you're in this business to come up with responsible credit models, but those are the nuanced factors that you really have to consider when you think about sort of generalizing and broadening this out.
It's a really interesting point, David, on sort of the over-engineering of the models. I mean, in a way, what we do is sort of the opposite, right? Like we enable folks to discharge loans. And when a judge and attorney is sort of considering should someone go through our process or not, it's interesting. It is quite engineered, right? It's not just income and debt. It's actually totality of circumstances, right? They're looking at things like the number of dependents. They're looking at things like, you know, the cost of living in a given zip code that a debtor lives in, right? And to Sam's original point, I wonder, is that an area that the ISA world ever wants to go in? Right? Like, is someone's bottom of the income statement relevant to you know, sort of how much they're expected to pay back? I think it's certainly relevant to their risk profile, right? Earning $80,000 in, you know, the Midwest with no dependents versus in downtown San Francisco with 3 kids, like a big difference, right? So I'm curious if that's something that should/will ever be incorporated into the ISA model.
Yeah, and I think, I mean, just like playing this out, you guys, I think this is a lot of why we end up back in this space of like regulation and how these things will play really matter. Because what we're really striking at, I think, with the ISA world and a lot of these kind of more sophisticated approaches to debt is this trade-off about like effectively what can and can't we factor in or acknowledge, right, now that we can measure it, about kind of very specific factors and differences playing into outcomes, right? Just broadly speaking, where you live, you know, race, in a world where like these things were unmeasured or unmeasurable, or you couldn't really do the modeling around it, and everyone was getting like pretty similar loan packages, you ended up, you know, that's one world. I think that it's an interesting implication of much more sophisticated technology and kind of the broader ecosystem moving towards kind of a scalpel versus a hammer, whatever the, sledgehammer, whatever, you know, in terms of how you think about these things, which is all of a sudden it puts into purview a bunch of these very complicated social questions, right? And asks us as a society to think about how we want to deal with them, right? You know, down to, and again, not to monologue too long, but Michael Sandel has a new book out, Professor Sandel from Harvard, you know, talking about the tyranny of I think the title of the book is the tyranny of meritocracy, and like what that kind of ends up looking like for as a society. I'm not sure if it's the title of the book. Someone can fact check me on that, but that's basically what it's about. It's a very interesting set of problems, and that's kind of what you get into when you think about it. The more bespoke these products become, you know, in a lot of ways, like you're forced to acknowledge that, or at least engage with that in a way that you aren't, right, when you don't have the data resolution to have those conversations. So I guess, you know, when you think broader picture, and again, I happy guys if you guys have other things you want to bring up, but like when you think about ISAs in the context of like what else, or like the broader ecosystem, you know, are there any areas you guys aren't seeing explored that you really think there should be investment in, or people should be spending time thinking about kind of the broader ecosystem of how we think about financing and individual people's, you know, endeavors and the risk rewards around them? Chris, you've seen so much across this industry in different slices. I'm curious if you have things you're just like, why hasn't this been explored, or why aren't people doing this?
Well, yeah. So first of all, I apologize if it was hard to hear me. I saw the little thing in the chat where you know, someone was asking me to lean in a little bit, which I was great. Most times people tell me to shut up. So thanks for that. Yeah, look, I think post-secondary education, and this is probably gonna be at a pretty high level, but I think that it becomes a very emotional decision for most folks, like what they're going to do. And, I'm speculating here to some degree, but, I have a couple of kids who have gone into post-secondary education, and I know for them it was, just as much about their heart as their head. I think there needs to be a real focus on providing people information, data, et cetera, that help them make that decision, right? And so if we look at the so-called student debt crisis today, $1.5 trillion in federal debt, right? The numbers are a little bit hard to triangulate on, but it's probably somewhere between half and 2/3 of that is the Grad Plus program, right? So put that aside for a moment. You have the other half, call it Pell, the Pell program, Stafford program, et cetera. And about half of that, so you're talking about $400 billion worth of debt is for people who have not completed school. And so what I always talk about is picture going in and buying a car, right? You go in and to a car dealership, you buy a car, they give you a loan for that. It's basically secured against the collateral, right? You have collateral, which is a car. Well, in the case of someone who doesn't finish school, you have debt and no collateral, essentially. I mean, I know that's very binary, and things are changing, which I'm glad to see. Folks thinking more about credentials and skills and whatnot than degrees. But let's be honest, that's still a case today. And so I think that there is a massive need to provide a framework and a structure by which people can make decisions about what is a good path to take. And I think that, a lot of people just don't focus on that as much as they should today.
Yeah. Fair enough.
I don't disagree with what Chris is saying. I'm respectfully sort of just point out, and he knows better than I do because he's been in the space a lot longer, but most folks who are in default are sort of borrowers with small 4-figure debt, right? It's not the folks that have $100,000 in debt, because most of those folks are grad students, right? I actually used to run a nonprofit that did explicitly what Chris is talking about, which is put folks through a really cohesive financial planning exercise. And the first product at Equity actually was an ROI tool. And what that type of tool ends up doing is it speaks to an experience that's not really the majority use case for most post-secondary going individuals now, which is sort of the luxury of choosing where to go to college that's not based on geography and sort of financial access. Right. So most folks who are going to college now are not sort of, I'm sure what many of us or some of us on this call were doing, which was getting to choose among a variety of institutions that weren't necessarily just the local or sort of state public school. There are a lot of individuals who are really thinking about community college, about vocational and technical training, because that's geographically what's accessible and what they can afford. So to me, the conversation about sort of prudent borrowing. Well, Chris is absolutely right. There is a cohort of Americans where that's the case. We should really be thinking about how can you make the 2-year training program or sort of, or that 4-year program more affordable ex ante, where the borrowing decision now is for those incidental costs that are not going to, there's going to be a higher probability of completion because the primary cost is covered. That's sort of the conversation that I think needs to be reframed, because the thing that's frustrating to me is whenever I read the Washington Post and the New York Times, we're talking about Harvard, Princeton, Yale, we're talking about a lot of public institutions. The majority education use case is not that, right? It's the community college, it's the vocational and technical training school, it's state universities, it's regional state universities, and increasingly it's alternative education programs, right? So from a policy standpoint, I think that's something that should be sort of more talked about than it currently is on the debt side.
It's a little bit offside, but I am curious, long range, what utility does, the repayment of an ISA sort of tell us about the creditworthiness of a borrower for future things, right? Like the point of going to school is to pursue a vocation, to build a career, and in theory, to participate in the economy and perhaps buy a house, perhaps, start accumulating some wealth. And I think so often now, folks that
some people would take issue with that, but I
fair enough.
But I agree from David's point he just made, I am 100% there.
No, fair enough. And some would argue it's the pursuit of knowledge, right? But yeah. I think that right now we see folks in their 30s and their 40s that made, frankly, one dumb decision, signing, the borrowing document 20 years ago because a guidance counselor told them this was the only path they could take, right? And now 20 years later, maybe they actually are like a good credit risk to purchase a home or to, start to accumulate assets, but aren't because of that bad decision. Does this allow for sort of a better lending ecosystem post graduation is going to be an interesting thing to find out.
Yeah, fair enough. Interesting. So again, we're kind of almost the end of our time here. We only have a few minutes left in the schedule for the session. And I think there's a quick break before we kind of continue the lightning thing. So thank you all for joining. Is there anything else you guys want to highlight kind of when you're navel gazing a little bit of where we're going in this like broader space of alternative finance, and how do we think about, moving beyond these crude models to like really helping people, have access to the capital they need to do the best they can? Again, I'm an optimist. I see a lot of really great stuff coming out there, and the ability. I actually think that opening up the path and more pathways to access to capital is one of the most important things we can do for our country and society overall. But I'm kind of curious, in closing, if you guys have any remarks you want to share.
Oh, sorry, Chris, go ahead.
No, please, David, go ahead.
I mean, so as we think about like quasi self-sustaining funding models, one of the interesting things we've seen from the field is that, again, subprime students who are receiving emergency grants, despite the fact that they have very little access to capital, have a hunger and a desire to pay it forward, right? So, this isn't a sustainable thing that can sustain a private business, but thinking about how you can create quasi-subsidized models where students can sort of pay it forward, where you're reframing what repayment is, which is the ability for another student to possibly attain their degree. Because when you think about repayment, it's like, why don't screw that bank, right? Or screw that company, like why am I giving them my money, right? But if you're reframing it as your ability to repay is actually furthering the outcome of one of your peers who will be going through what you're going through, we've seen a real desire for individuals to contribute back. So as we think about, creating more self-sustaining models, that's something we're excited about, is a pay it forward model and how we're reframing that. You'll have to talk to me in 6 months about what that means from a regulatory standpoint. But that's an interesting thing that we're exploring.
Yeah, I would say, just as a final thought, I do think that the regulatory environment is going to dictate a tremendous amount of, what this looks like. The entire alternative financing market looks like, 3-4 years from now. I think someone on the previous panel, mentioned some of the work that the Senate Financial Committee has been doing. We've been watching that very closely, and I think they have started to poke around in the alternative financing space, whether it be, things like what Meritize does or ISAs do. And one of the things they're keying on is whether you are actually making decisions about any type of financing that is based on the individual attributes of that applicant versus pooled attributes. And that is, I think, one of the key questions. I'm sorry to be provocative with 1 minute left, but I think that is one of the key questions about where this goes from here.
Like Sam, I am an optimist. Like Chris and David, I think regulatory is the iceberg in the way of all this. One thing I will say from an optimistic regulatory perspective, perhaps, is that I do think, in our world, as we see older judges that are retiring, that didn't ever allow a student debt case to even be seen, I do think the sort of newer generation of administrators, of regulators, of politicians, right? I think there's a greater level of empathy for what we're seeing and what we're going through here. And so I'd like to think that this is a tide that's not going to take, decades to turn. But I do think the momentum is certainly headed in the right direction, even in the regulatory piece of this, which is certainly the hardest.
Fair enough. Guys, that was great. And I love this question. I mean, I just wrote this down, which is, the big meta framing of, can you make decisions based on individual characteristics or only pools? And what is the definition of a pool? That's a wonderful point to pull out, Chris, and a great framing just from my perspective, because what I'm thinking about is obviously it's relevant immediately in the financing space and things like that. But the reality is, if you think big picture about technology, this is the question. Like, if you want to, people's questions about Facebook advertising targets and news feeds and whatever, that's it. Like, that is the question, which is now that we all of a sudden have the ability to look all the way down the rabbit hole, right? Have these long-term, engagements at a one-on-one level in theory, and where do we set those lines and how do we think about those lines? And how they inform kind of what the society you want to build, because you never had those levers before, but now that you do, you have to deal with what they mean. So thank you three for this panel. This was really awesome. I appreciate all of you guys participating. Adam, can you undo your video, jump on for a second? I believe we have a 5-minute break now. Is that correct?
Yeah, we've got a 2-minute real quick break to just like stretch your legs, and then we'll be back with the policy panel.
Excellent.
I'll come back in a couple. Thanks, Sam.
Awesome. Thanks, guys. We'll talk soon.
Want to quickly invite up our moderator, Ethan Pollock, Liz Simon from General Assembly, and Kevin from Better Future Forward for our next panel on ISA policy and some of the really relevant policies going on right now.
Adam, thanks so much for that, for kicking it off to us. And I just want to thank Slow Ventures, Whiteboard, and JFF as well for kind of putting on this event. The Future Work Initiative at the Aspen Institute has been looking at ISAs for a while as a potential way to kind of improve access to kind of higher quality training programs, with the idea that they could potentially promote greater economic outcomes, but at the same time, very cognizant of a lot of kind of the risks that ISAs present, both a lot of the risks that are similar to kind of existing credit programs, but then also potentially some new risks that are kind of really unique to ISAs. And so I'm really excited to have this discussion with Liz and Kevin. Before we jump into the policy discussion, actually, Liz and Kevin, would you both like to briefly introduce yourself and kind of describe how General Assembly and Better Future Forward use ISAs?
Sure, happy to. Hey everyone, I'm Liz Simon. I'm the Chief Operating Officer at General Assembly. For those of you who don't know, General Assembly exists to equip individuals and organizations with the most in-demand skills. We have been around for about a decade, and over the last 2 or so years, we have utilized ISAs to fund our consumer programs. So we started in 2018 with an ISA program that has been wildly successful in terms of demand and utilization. About 40% of immersive students, which are our full-time programs at GA, use income share agreements today. We've also expanded this year through a partnership with Social Finance to what we're calling an impact ISA, which is focused on folks who are either A, eligible for public benefits, B, have touched the criminal justice system, or C, do not meet their credit requirements of our traditional ISA program. And that's been very successful as well. So that is a bit about our experience with ISAs.
Kevin?
Hi, everyone. Yeah, thanks for the opportunity to be here. My name is Kevin James. I'm the founder and CEO of Better Future Forward. I started this journey as a legislative aide, working for a member of the House of Representatives who was on the Educational Workforce Committee, and did several years worked on the income-based repayment programs for federal student loans. So that was my introduction to the long academic literature of income contingent financing, and came across ISAs. The name didn't exist at the time, but in 2013. And just got very interested from a policy standpoint. So asked people why this idea had not sort of taken off. As one earlier panelist noted, it's not a new idea. And one of the points that came back was just there's not a lot of legal clarity around this sort of novel financial tool. And so that led me working with Congressman Petri at the time, my boss at the time, and Mark Rubio's office to work on sort of the first iteration of the federal bill. And so worked on some of those federal policy questions. And in 2016, kind of took the plunge to go to the practitioner side and found BFF as a nonprofit, really with a desire to David's point, to create, our funds are community-based. And so we create ISA programs right now focused on lower income students who are pursuing a 4-year college degree, and really trying to create something of a revolving philanthropic fund within these communities that helps students meet their cost of college as a complement to federal aid sources. And we've seen just a tremendous impact in terms of being able to achieve persistence and graduation rates for these students of 93, 94%, which I think is very strong. And so we've been happy to see that, and but also continue to do a lot of work on policy.
Gotcha. Thanks to both of you. So let's really just dive into the consumer protections themselves. Why start off with kind of a high level question? Why do we need consumer protections for ISAs? What are the risks of not having any types of guardrails in place, both the risks for the consumers themselves, but then also for kind of the industry at large? And Kevin, I'll start off with you.
Sure. I think ISAs have a lot of appealing characteristics relative to debt, and people have hit on this. I think what drew me was and ideally they can be a broad funnel on the front end, so they're providing access to capital that just is to underserved populations that did not have had it in the past, and tied to a protection mechanism or a payment mechanism that can be protective of their financial future and tied to outcomes. And ISAs are the only tool that I've really ever found that brings those things together in a really compelling way. I think the danger is it's easy to fall into a trap and feel like because they have these characteristics that in many ways are better than loans, that to think that that's enough, when really these characteristics they're not self-executing in terms of being protective. I mean, as I've jumped into the practitioner side of ISAs, it's only enhanced my understanding of just how many levers you can pull with an ISA. There's just loans, it's your interest rate, it's your repayment schedule. ISAs just have thresholds and caps and terms and payment windows and qualified payments. There's a lot of levers that you can pull, and it's both a strength. I think it facilitates a lot of innovation, but at the same time, I think it creates opportunities for abuse, and it can particularly create very complicated products. And so I think my appeal would be, I think there's been a lot of well-intentioned efforts in the space to push towards getting kind of standards, but I would say we really need to dive more into details, because sometimes I think we've said we want these things to be affordable, we want a fair cap, we want a fair threshold, but sometimes you can build ISAs that sort of meet that definition, but still can be quite unprotective in terms of just, if you get the details wrong, you've created something that can seem very nice on the surface, but actually not be all that protective. And so I think the biggest thing is the risk of that, of course, is abuse, that there will be abuse, and that most directly will impact students. But at a macro level, the risk is that policymakers and others sour on this idea, and that there will be sort of regulatory approaches applied to ISAs that really just stifle people's ability to even apply them in a good way. And I think that would be a tragedy. We have a lot of great programs here that are doing good things in the world, and we want to help good ones thrive and prevent bad actors.
And Liz, how do you see some of the risks to students if guardrails are not in place?
Yeah, I mean, a +1 to everything that Kevin said. I think he hit on many of the main points. At the end of the day, like I think the main thing I would just highlight that Kevin said, which is, and sort of double down on, is like there's just high variability in terms of terms for students depending on the sort of provider or program, and that has a real potential to be harmful to students, given the complexity of the various terms and levers. And so, like, from my perspective, like that is the most potentially harmful thing for the industry, which is that like all of a sudden like bad actors, emerge, and then we're painting with, too broad a brush around, that there's sort of tarnish on the whole sort of spectrum of ISAs, which I think with appropriate guardrails can be for some students a better financing mechanism than a traditional loan. And it's about, the fact that like it's not necessarily the right option for everyone, but for many students, it actually is the better option. And preserving that ability is super important for us, and why we've advocated, from kind of day one for sort of, appropriate guardrails, from the federal level on down.
Yeah, and I think that the point in particular about worrying about kind of policymakers and advocates kind of souring on ISAs is also I think definitely potentially important. One of the areas that I've heard some of the criticism has been less about kind of that the industry does not support kind of new protections, but rather that they are not kind of abiding by or taking seriously enough kind of some existing protections. So I kind of want to talk about kind of those kind of existing consumer protections themselves. At the federal level, those could be the Truth in Lending Act, Equal Credit Opportunity Act, Fair Credit Reporting Act, Fair Debt Collections Practices Act, the Military Lending Act, state level, a variety of protections, then including kind of usury caps. And so, a lot of the advocates believe that kind of we're just trying to kind of get around those. So, how do we make sure that ISAs are subject to existing protections, and how should those existing protections actually apply to ISAs, with the understanding that some of those protections were explicitly written with things like an interest rate in mind, which ISAs do not at least have an explicit interest rate in their contracts. How do we apply those existing protections to ISAs and make sure that they are covered in the same kind of credit protection system as any other credit product? And I'll go back to Liz first.
Yeah, I mean, I think the point there is like, these things are all need to be sort of harmonized together. Like there is definitely a set of existing, sort of regulatory parameters, but it is unclear. I mean, I can say from the point of General Assemblies, like it is unclear in some cases how and where those things apply or don't, given the differences between ISAs and traditional loan products for which they were intended. And so you try to like adopt the spirit of what, what's going to be in the best interest of the student. And that's how I can say that we've approached those things. I think it gets tricky on the state-by-state basis. Like it is for someone like General Assembly that operates, in 35 states or whatever. Like it's, the state-by-state approach is tough, and so we're certainly in favor of having more standardized from the federal level on down, because obviously with our state consumer protection regimes everywhere we operate, but we've also been in the business of like having to deal with individual regulators in every state, asking questions about ISAs, which is also challenging, and having really differing sort of perspectives and understandings of what these are and what they aren't. So I don't know if that totally answers the question, but I think the answer is like it's not an easy one.
And I know, Kevin, you've done a lot of thinking about kind of how to take a lot of these existing protections and apply them to ISAs in a way that really is consistent with the spirit of kind of these protections. Do you want to talk a little bit about kind of some of your thinking in that area?
Yeah, and to Liz's point, it's complicated, and I think there's the legal questions around just being providers operating within the current legal environment, and under certain laws, for example, TILA disclosure just not fitting very clearly with the structure of an ISA. So the first thing I'd say is just, I think it's really important to, as Liz was saying, do everything we can to comply with the spirit of laws and even the letter where possible. So give TILA disclosures with, adapting them as necessary just to maybe show a range of outcomes of what someone would pay. And I would say, I would go as far as to say, show an effective APR for each one of those potential outcomes so that you're translating it into terms so someone can see if I earn $40,000 a year, I'll pay an effective APR of 3.6%. So that it's really trying to uphold the sort of cross comparison shopping goals of TILA. So I think in a lot of different areas, it's really important to do everything we can to live by the spirit of those laws, recognizing that some of them are very unclear in their application. And then as a matter of policy, I think we really should work to go through and apply all of the existing consumer protection regime, but then look for areas where those things don't make sense and adapt them so that the spirit of those laws is truly upheld in the context of ISAs when you're actually thinking about true policy changes.
Yeah, and Liz, you had mentioned kind of this kind of ambiguity in which kind of you're operating right now, and I mean it's so difficult with so many different protections at the federal and state level. And have you or do you believe that there is some opportunity for industry to really kind of, instead of kind of individual providers trying to kind of interpret things on their own, is there an opportunity for industry to be a little more proactive? And potentially they're coming together towards some kind of standardized practices that they believe are consistent with existing law, and or potentially even kind of working with, proactively working with regulators and trying to get kind of interpretations or opinions, so that that kind of like in the absence of kind of clearer guidance, that this is kind of the best way forward.
Yeah, absolutely. I mean, I think that is certainly my preferred approach forward, and General Assembly's preferred approach forward. I think at the end of the day, like, this is one of those things where you want to be proactively shaping what the future is going to look like, and any future regulation is going to need to take into account sort of the perspectives of all the stakeholders involved, including the providers in the industry, as well as all of the sort of advocates on consumer protection side, right? Like this is important, and there have been some efforts already for industry to come together with one more unified voice on this topic. And I recognize a lot of the names and faces on the call today of people who've been involved in those efforts. And so, whether we're sort of in the lead or not, like, we're putting our name against sort of, I think to the extent that there are sort of agreed upon sort of norms and standards that we'd want to encourage being, as a high bar set for the industry. Absolutely.
And so that's kind of, tackling kind of, some of the existing protections, but, ISAs also are fairly unique, right? And then they may pose some kind of, unique risks themselves to students. Is there a need for us to go, not just to kind of comply with existing protections, but a need to go beyond existing protections? And if so, what do some of those kind of like new protections look like? Liz, start with you.
Yeah, I mean, I think given the sort of the different, Kevin called them the sort of different levers around an ISA, I think there's room for thinking about new areas of regulation. For example, how should we think about caps? How should we think about, minimum income thresholds? How should we think about, like repayment periods? How should we think about, all of those sorts of things, percentage of income, like all the things that sort of go beyond, things that exist in our current regulatory environment. where can you manipulate those? You'd want to think about, like, where can you manipulate? Where could one who is wanting to be a bad actor manipulate those levers? And then how do you sort of put in a reasonable benchmark to say, like, you know, I don't know, you caps you shouldn't have a 4x cap, or you shouldn't be able to have, you know, you shouldn't be able to have to pay up to 4 times, you know, the price of a you know, your tuition price or something like that. So I think that's where the kind of new pieces come in to play. And, you know, I think there's been some sort of collective discussion around kind of like what good looks like, or what reasonable looks like in that space already.
Yeah, I would second what Liz is saying and say, I think there's so many aspects of ISAs that were not envisioned by the people who wrote a lot of these current laws, many of which were written decades ago. And so I really think it's incumbent on us, and there's a degree of urgency here to try and work through what can be a pretty technical set of questions around what should these guardrails look like? Because as I was mentioning, there's already sort of questions about applying existing laws around TILA and how you disclose ISAs under TILA, but I almost think about it as a series of layers. So for example, there's questions around ACOA and how that should apply, and whether we should have more disclosure, for example, around making sure that there's a broad funnel of students on the front end and not any kind of discrimination. Under TILA, even besides what I mentioned around how to disclose sort of the payments that you might pay, there's questions around about terms and like what constitutes a term. I think in the ISA space, we've all had different approaches at times around, is it a term that can defer up to a certain number of years, or is there a payment window? And if you make a certain number of qualified payments, then you finish early. I think getting clarity around things like that could really help to disclose the product in a consistent way. And then like layer 2 is I think kind of specific to ISAs. It's around, you know, creating those affordable payments that really is no guarantee for private loans. And so is there, you know, mechanisms that we can create to set a minimum threshold, to sort of set some kind of mechanism for a maximum income share and how you would calculate other obligations in that process, maximum payment periods. A third I think is really important is, even if you create something that is disclosed clearly and has those protections around affordable payments and a reasonable payment period, you can still have something that is just priced in a deeply unfair way if you're just not giving someone a very small amount of money in exchange for that income share. So I think thinking about what I guess we call usury in the context of ISAs, maybe around thinking about making sure that the ISAs are priced fairly in expectation, I think is a really meaty and technical topic that we've done a lot of thinking on it. I would love to talk with others in this group. And the last one that comes to mind is default. And for example, acceleration and accelerating up to the cap, and what types of things can, you know, ensure a fair treatment for students who are in default, and one that is still sort of ensures the sustainability of the instrument, but first and foremost has to be protective of students. So I think there's just a range of topics that require a lot of thought, and we've been doing a lot of thought on it. I would love to talk with others who want to kind of dive into these topics.
Yeah, and you know, Kevin, I'll just second that emphasis really on kind of the acceleration, accelerated payments in particular. I mean, I think that, you know, ISAs do have kind of are making certain promises that loans don't make, right? You know, that there is a certain promise here. I think that's why we're all here, is because we believe in the potential of that promise. But then thinking about, I think, you know, how there are certain levers that providers can pull that could violate that promise. And it does feel that abuse or overuse of kind of accelerated collections is one where kind of, you know, really the promise is that we are taking on some of that risk. Your payments are going to be affordable, and that that acceleration clauses, while I understand kind of why they exist, does seem like that's one of the areas that could potentially, you know, violate that promise. And I could see then the need for kind of you know, policy that specifically kind of regulates that practice. One last question. When we are thinking about regulating ISAs, both kind of thinking about how to apply new protections and existing protections, Are there any dangers to, this is a new market, right? And this, that it's fairly inchoate, that, these products are still evolving. I know we talked at the top about the danger of kind of not putting guardrails in place, but is there a flip side? Is there a danger in regulating kind of too quickly or too prescriptively that either kind of snuffs out innovation, or on the reverse side doesn't anticipate some of the different ways that ISAs could get around protections? I've heard this from some kind of consumer advocates that they actually don't want to put on kind of new protections because they haven't actually fully seen the market mature, and they want to wait for the market mature. So I'm curious how you think about kind of that balance between wanting to act, don't want to act too late, but also maybe don't want to even act too early. So either one of you. Sorry, I didn't specify.
Yeah, I mean, my quick take is just that, like, you got to thread the needle on that one somehow. I think that, and that's always the hardest part is, like, I do think, without being too prescriptive, you can certainly layer in things like disclosures and transparency, and some sort of like far end protections without kind of micro kind of getting into the sort of like very detailed prescriptive approaches here. And I think, I mean, listen, we're seeing like things that are still like, we're still understanding how these products are working and how they're actually manifesting themselves for students and what the impacts of those are. And so, I think there's definitely truth to that caution, which is, but I think, again, threading the needle to find sort of like what are the things that while we like watch this develop, we know already, or we want to be able to see transparently, or we want to be able to make students aware of. Like, those are the kind of focus areas where I'd put my initial, sort of bets.
Yeah, I would second what Liz was saying and say, 4 years ago, when Purdue was first launching, when we worked on some of the early iterations of federal bill, I would have said, yes, it's much harder. I mean, I think the federal bills were our attempt to come up with something that was a starting point for a discussion. But now, I still think the question is very relevant. Like, I think we don't know how this will evolve completely, but I think we know enough now to at least propose sort of broad frameworks that could really put some I think, highly effective guardrails in place while still allowing a lot of room for innovation. So when you think about the principles around, like, how do we clearly disclose an ISA, just disclosing, the range of effective APRs and payments that you might make, affordability, just thinking about putting some basic guardrails around maximums that people can commit, considering their other obligations, talking about payment windows in kind of consistent ways across the space. And then I think in terms of fair pricing, just thinking about, like, where do ISAs get out of whack in terms of, you can have lots of different ISAs in different sectors, but fundamentally, if something is, I would say it as simply as if a provider or a funder is making money even when students don't do well, like, there's just something wrong with that equation, and that's not sector specific. And then again, on default and acceleration, I think there's still a lot to learn, but I think we can, take some steps to talk and try and figure out and pin this down more. And I think the next step needs to just be a lot more conversation between us to work through some of those questions.
Great. Well, Liz, Kevin, thank you so much for the great discussion. And Adam, I'll turn it back over to you.
Thanks so much, Ethan. And thank you, Kevin. Thank you, Liz, so much. Really good segue from policy now to really diving into some of the specific legal considerations for ISAs. So would love to invite up Alyssa, our moderator for this next panel on legal considerations, as well as Jonathan and John. Do you guys want to come on up to the proverbial stage?
I think we're here.
Sweet.
Great. Well, Adam, thank you so much. And my name is Alyssa Garden-Schwartz. I am a shareholder at Brownstein Hyatt Farber Schreck. I'm in their litigation consumer protection practice group and was previously the deputy for consumer protection in the Colorado AG's office. I am thrilled to be hosting this, or to be moderating this panel today on legal considerations for income share agreements. I will briefly introduce our panelists so we can get going on the substance because we've got a lot to cover. So I'm joined by John Culhane from Ballard Spahr. He's a partner there in their Philadelphia office and is an expert on all things consumer finance related. And we also have Jonathan Joshua, who is the general counsel for Vimo Education, an ISA provider who also has had a long and distinguished career in education finance and consumer finance. So this is, as Adam said, this is a great segue from the previous panel. We're going to talk a bit more in depth about the legal framework that may or may not apply to ISAs, just because there isn't an existing overarching regulatory structure that's applicable. That doesn't mean that ISAs operate outside the law, or that ISA providers and schools believe that offering ISAs is somehow a way to avoid existing laws. So I want to first turn to John and ask you, John, to talk about, sort of what the existing framework is that ISAs operate under as a financial product and an education finance product, and specifically to talk a little bit about whether consumer credit laws in particular would be applicable to ISAs.
Thanks, Alyssa. Hopefully my mic is working here, but if anybody has any problems, let me know. I'm going to talk a little bit about the legal framework and then talk about specific consumer laws. I think we've heard from the policy discussion and possibly from earlier discussions that an ISA is really a unique product. There are similar types of products in the marketplace, but ISAs, certainly in the education space, are somewhat unique. And the theory under which ISAs are structured is that the product itself is not a loan, or it's not an extension of credit. And that's the case under common law, the decision law cases in our states, as well as under most statutes. And the reason that an ISA is not a loan or an extension of credit is because there's no unconditional obligation to repay. That's the distinction we make in the law between loans and investments. So if there's an unconditional, unfettered obligation to repay, then you have a loan or an extension of credit. And if your principal is at risk, you really have an investment. Now, we have similar products in the marketplace, and it's always a good idea to keep an eye on what's happening with those products. Some of them have evolved to the point where there's a statutory regimen governing the product, but you want to keep an eye on what's happening with litigation funding cases or litigation funding products. I'll say a little bit more about that shortly. Pension advance is another similar product. Structured settlements have evolved somewhat to the point where a majority of states have a statutory regimen under which structured settlements can be offered. And merchant cash advance. Merchant cash advance is likewise a product structured not to be an extension of credit or a loan. It seems to be moving forward a little faster in the regulatory space. So it may be one to watch to see what's happening and to get an idea as to how federal and state regulation might evolve. Notwithstanding the fact that at common law, these products aren't loans or extensions of credit, there are some states that beg to differ and that do consider the product to be an extension of credit or to be governed by their credit statutes. And I think the lead state in this case has been South Carolina. South Carolina has an opinion letter going back to 2017 concluding that the ISA product under consideration would be governed by the Uniform Consumer Credit Code as enacted in South Carolina because it would either be a debt or it would be a sale or assignment of wages. I think the analysis in that letter is a bit sloppy and maybe dependent on the specific facts and how that ISA operated. But I would argue that it's not a debt. There is no debt. And I think it's misleading to say that there's a sale or assignment of wages. What there is an ability to pay, or a measurement of an ability to pay, and a measurement of an amount that is to be paid based on an individual's income. South Carolina seems to be the leader here, but Iowa arguably is taking the same position. To my knowledge, there's no public interpretation, but Iowa Attorney General Tom Miller authored a blog post that was very critical of ISAs, and he appeared at the Student Borrower Protection Center program on ISAs, in which he seemed to take the position that ISAs were tantamount to a sale or assignment of wages. I think misunderstanding how the product operates, or simply following the position taken in South Carolina. So there are some states that may interpret their statutes to cover ISAs. We're also watching to see what happens in other states where there may be new legislation. And there seem to be two approaches to that legislation in general. I would say the federal approach, the federal bill that isn't going anywhere, represents one approach, an attempt to provide a framework to answer legal questions about how an ISA operates and how it should be considered under credit laws, tax laws, et cetera. And then there are statutes or bills which really seem to be designed with the intent to make it very, very difficult to offer ISAs. And I think the Illinois bill that was introduced and is still in, I think, still in the Rules Committee in Illinois is an example of the latter approach. It's really not so much an attempt to allow the product to grow as it is to restrict the pricing very significantly and make it very difficult for companies that are currently participating in the marketplace to offer a product that looks like their current product. Now, watch California, because we're clearly going to see some developments there that are going to be very significant. I think we all know that California passed its mini CFPB bill, too many B's there for me, passed its mini CFPB bill back in September. At this point, I think everybody knows that there's some very artful drafting in that bill. And in particular, that bill defines, or now law defines, debt in a way that an unconditional or a obligation to repay an amount that is conditioned and is not absolute is nonetheless deemed to be debt, and credit is defined as incurring debt or incurring debt and deferring its payment. So clearly, the Department of Financial and DFPI, professional innovation, product innovation.
I think it's the Department of Financial
Protection and Innovation.
Protection and Innovation, yes.
Protection and Innovation, yeah. Has the authority to do something. We've talked to folks there, and they're not signaling what they intend to do. Presumably they haven't decided what they intend to do at this point, but they have a lot of experience with ISAs. We've watched what's happened with Lambda and the Holberton School. We know that there are other ISA, non-education ISA products being marketed in California, and that those products have been reviewed by the predecessor to the DFPI. So we really need to watch California carefully to see what will happen. In the meantime, even in the absence of statutory and new statutes being enacted, we have the Student Borrower Protection Center arguing that there are many cases where ISAs are in fact extensions of credit, that the common law doctrine does not apply. And the theory that the SPBC is advancing is that if the facts are right, then if you have a high graduation rate, a high placement rate, then payment is a virtual certainty. And the virtual certainty test is an exception to the not a loan or extension of credit because no absolute obligation to repay. And the theory is that if things are structured in such a way that payment is a virtual certainty, then the obligation really is a loan or extension of credit. Now, that should be a really high bar, virtual certainty. Unfortunately, there are a bunch of litigation funding cases where courts clearly didn't like the product and really stretched to conclude that funding was a virtual certainty. So if there was some indication of an award early in the litigation funding and the award would be used to pay off the litigation advance, courts strained to find a virtual certainty of payment, notwithstanding the possibility of judgments being set aside or awards being set aside or further appeals, et cetera. And in that regard, I want to caution everybody, you should watch some litigation that's pending in New York right now. It's sort of not gotten a lot of attention in this space, but there's a key litigation funding case pending before the New York Court of Appeals, its highest court. The case is the fast track case. And this will be the first time in a long time that New York's highest court has talked about what the distinctions are and at what point do we move from no absolute obligation to repay or we'll move over to an absolute obligation to repay from unconditional, from a conditioned obligation to repay. Some jurisdictions may be following this approach. There have been some suggestions that some jurisdictions have, some regulators have seen ISA products, not necessarily in the education finance space, and have concluded that because the participant already has a job, already has an income, that's enough to meet the virtual certainty test, and that those ISAs would be loans or extensions of credit. I don't want to use up all of our time here, but even if not an extension of credit or a loan, we've had a lot of discussion about what it means for a product to be fair. So we should keep in mind that state and federal laws that regulate fairness and deception and abusive practices will apply here. In addition, there are federal and state laws in the consumer credit space that will apply if you're using credit reports in making decisions in any sense, or if you're furnishing information to credit bureaus, then you're going to be subject to the Fair Credit Reporting Act. You're going to have, although you usually will have, a permissible purpose. If you have a hard denial because of some information in a credit report, like a bankruptcy, you're going to have to give an adverse action notice. There are also state statutes that are sort of standalone statutes that can limit late fees and NSF fees, and they may be applicable. If you get to the point where there's a fixed amount that's due and you're trying to collect that amount, federal and state laws that apply to first and third party debt collection will apply here. And there's really lots of room, even if you conclude that these aren't extensions of credit and credit discrimination laws don't apply per se, there are lots of statutes that prohibit discrimination that could be operating in this space. There are civil rights laws at the federal level. Those civil rights laws have been cited in the litigation involving the DACA students. There are laws that prohibit discrimination in places of public accommodation. And a website, although the case law on this isn't settled, a website is typically considered to be a place of public accommodation. And then I think the Student Borrower Protection Center and others have focused on laws that apply to colleges and universities receiving financial aid that prohibit discrimination in any program or activity that's receiving federal funding. So there's a lot of room for discrimination laws to apply. Let me stop there. And Alyssa, I think you had some comments on fair treatment and fair lending.
Yeah, I will. I mean, I will just briefly say that you know, to build on what John was saying, is that You know, I mean, ISAs are still a financial product. They are still going to, in light of the laws that may potentially apply that John was just discussing, certainly behooves ISA providers to keep an eye on the impact of their products and whether there needs to be adjustments to ensure that there is no, you know, disparate impact. That said, I think ISAs already sort of have some inherent characteristics built in that make them less susceptible to disparate impact. You know, there have been studies done on the use of credit scores and FICO scores and how that could, you know, end up with a discriminatory product because of using somebody's past credit history and past performance to predict their credit worthiness going forward. You know, most ISAs they're not priced based on FICO. They are priced on, you know, future potential. And so that already has the potential to eliminate the chances of disparate impact. But nevertheless, I think I think ISA's providers, and I think they do sort of keep an eye on how their products are performing to ensure that there is no disparate impact, there is no discrimination. I see that there are a couple of questions in the chat, and I definitely want to get to those, but I also want to give Jonathan a chance to talk about you know, in light of the fact that there are laws that may still apply here, and that, you know, there's certainly an interest in having this product be a consumer-friendly product. You know, Jonathan, if you can talk about sort of what best practices have evolved within the ISA sector, and also talk about, you know, contractual provisions and such that folks should look for in an ISA to ensure protections.
Sure, thank you. Well, you know, I think this is a great segue, because all the stuff that we just talked about is all stuff that people need to think about when they're planning to offer an income share agreement program, and need to incorporate all of the lessons learned from laws that maybe don't apply directly, but are informative of what people think is fair and right, as well as all those laws that do in fact apply with respect to the actual process of you know, originating and administering income share agreements, whether it's making sure that, you know, if you have an electronic signature, it's done properly, to ensuring that you're compliant with any restrictions on communicating, you know, whether it's sending text messages or emails, or, you know, to the extent that like John said, if there's a fixed debt at the end, that there's a debt collection requirement, you want to make sure that you have you have implemented, or you have a partner who's implemented policies and procedures and practices designed to ensure compliance with those things. I mean, ultimately, if you're an institution offering income share agreements, this is your reputation on the line, and you need to you know, bear that in mind as you go through the ISA process, that you know, your reputation is still on the line. So you want to make sure that your disclosures and the terms of the ISA agreement are obviously fair, as we've talked about, but also that you've, you know, clearly and conspicuously disclosed the key financial terms. I mean, broadly speaking, it's valuable to take steps to ensure that students actually understand the terms of their ISA, especially because it's a somewhat newer product. It may be harder to get good advice. I mean, not that you know, every student gets great advice about student loans, but with a new asset class, maybe there's a little bit more of a possibility that folks either won't understand or can be more convincing in claiming they didn't understand. But so it's important to make sure that students do understand that your marketing reflects the terms of the product that you're offering. And so, you know, you don't want there to be a disconnect between the terms of the ISA and the way you've described it to students. that is stuff that they will bring up later when they're surprised, and nobody wants to be surprised. And when we talk about fairness, I think it's important to think about fairness within the scope of what an ISA is, with not necessarily what fairness is in other contexts. ISAs have different features, have different economic terms, and a feature that maybe would look inappropriate in a loan context is not necessarily inherently unfair in an income share agreement, and vice versa. So, I mean, when you talk about, some of those aspects of the ISA, you want to be thoughtful. So, for example, we talked a little bit about default. I think it's important to recognize that non-payment of an ISA is not a problem. That's the product working as designed if their income is below the threshold. And when you talk about default in a loan scenario, often you're talking about somebody who just can't afford it. It's not to say that can't happen with an ISA, but for the most part, that's not, that shouldn't be why defaults are happening with ISAs. Defaults with ISAs will hopefully be less about just they're not earning very much, to either specific hardships, or they're just not willing to participate in the contract. And so when you think about fairness and equity, I think it's important to bear that in mind. Obviously, if there's a hardship, you want to treat them appropriately. But if they're sort of acting in a willful manner, I think the equities there are also slightly different. So it's important to look for a partner that can be thoughtful and compliant throughout the ISA life cycle, and particularly thoughtful around the less happy paths that students can have. You want to have a compliance program. You want to have a process for monitoring complaints, and you want to make sure that your provider is being thoughtful. And I think likewise, when you talk about contract issues, it's important to apportion responsibility for these things where it belongs, with the folks who are actually doing the work. And it's important to validate that they can do these things and do them well and do them right. And then you obviously want to be careful. Obviously, information security, privacy, all these things are also going to continue to be heavily regulated. And you want to work with somebody and ensure contractually that you've got the right partner, you've got somebody who is thinking about this. And the last thing I'll add isn't strictly a contractual issue, but I think it's important also to look for folks who are forward thinking about this. We've been talking about how these things are going to evolve over time. And, having a partner who is able to, try to help plan for the future, try to help you deal with education regulators, financial regulators, unhappy students, or whatever the case may be, can also be really important. So I'll stop there, and because I think we're probably close on time, and there are some questions.
Yeah, no, and we are, as I suspected, there's so much to discuss here, and we had sort of a truncated time frame, but I think we were able to pack in a lot of good information in that time period.